And I would say that's what I'm most concerned about. We've seen such an amazing rally. If you look at, for instance, at the dot-com bubble, where the idea was that the internet was a brand new technology, it was going to change the world. And you had these crazy kind of, dot-com companies that barely made any revenue, run out of their parents' basement almost, going to multi 10, 20, 100, $150 million valuations. It's very similar to what we saw over the last 12 to 18 months in the cryptocurrency industry, with meme coins that were made as jokes getting $60 billion valuations. And what we saw in the dot-coms is a flush out that basically wiped out a lot of the crap. And then the quality survived. The Amazons, the Googles, they flourished because people were right. It was a technology that had staying power. So then you look at the crypto market and you see something like Amazon, the equivalent maybe being Bitcoin. So yes, it might have to get a flush to wipe out all the other junk out there, but ultimately I do think it survives and thrives. If you look at the 2000 chart, the year 2000 chart of Amazon, when it was topping, you see the exact same pattern as what Bitcoin has formed since April's high, November's high of 2021, that big M top. So little things like that are very similar. Another similarity that's kind of intriguing is that at the height of the dot-com era, it was about $2.9 trillion in dot-com market cap. The crypto market, I believe in November, hit 3.1. So just around the same level. So those type of things get my attention. And also, you see, we didn't really have social media back in 2000, but you see this kind of over exuberance. There's irrational exuberance, to use a Greenspan quote, in the crypto market, where people just got so hyped up and are still so hyped up that almost never lasts. You need some sort of flush out. So Bitcoin has this beautiful M top, which again looks identical to what we saw in Amazon in the 2000 era. And then you could see here is that this is staying within this channel. So you connect this low to this low, and the parallel line connects perfectly through these highs. And we just hit it right here, the high end of that area. So as long as this pattern continues and you stay inside of this channel, this is actually a bear flag formation. So if you look at the big move down right here, this is all inside bar technical price action inside of this bigger move, staying below the 200 moving average. If you looked at 1,000 of these charts that have this same formation or had this same formation, I would say probably 70 to 80% of them ultimately break to the downside. So it again leads you to believe that even though you're seeing a lot of hype in the crypto market, again, with this little move up in Bitcoin, it likely is not the end of the downside. The one thing that would change my mind if we started to establish ourselves above this area. All right, so this pattern, if this holds, it's bearish. If you start trading above it, then that could change. The pattern is then weakened, potentially voided, and then maybe you start trading back to the upside. So a lot of average investors get fooled by like one close above and they jump on the bandwagon because they're so pumped up. That oftentimes can be a fake out. It can be done by institutions to try to stop out shorts and get longs on the table before they run it the other way. So you really want to see it kind of at least a multi-day close above it, or a weekly close would be very, very powerful. A couple of the other cool things with this chart, I just want to show you guys this, is that if you look at this past move, right? So this is the most similar period to this over here. It's very, very similar. One of the cool things to see is that if you took the low here, this was on May 19th, 2021, the bottom right here was the 20th of July, right? So basically 2 months and 1 day, and then you began this move up. If you take this low was January 24th. Well, guess what? The beginning of this move was virtually the same 2-month span, and you've gone up here. Now, a lot of people would say, well, why this one broke sharply to the upside, so why won't this one? And there is a distinct difference here. This is a down sloping channel, right? So and let me draw that a little bit more clearly so you guys can see it. So if you look at this, price was going up and down inside of this pattern here, okay? And then you broke out. If you look at this, the difference is that this one's an upsloping channel, right? So this one, again, knowing how charts work, this is bullish. It usually breaks up. this is bearish, it usually breaks down. You are buying into resistance. So imagine standing in front of a brick wall 1 inch away and trying to run through it, right? You're not getting through it. You don't have the momentum to go through it. So
unless you know Kung Fu, right?
Right, exactly. You might have the whole world on Twitter or on social media cheering you on and saying, hey, this looks amazing, but you have to look at the facts, and the charts really show us the facts. Now, at some point, if you were to get a consolidation pattern where it got some momentum, then maybe it could break through. But the odds, again, of this breaking through right here are very low. Now, again, you can see it's all of a sudden stopped right there. It's kind of pausing. Pausing's okay. It kind of could be gathering itself at that point. I'd like to see a little bit more of a pullback before it makes an attempt. But right now, buying into resistance is never something you want to do. And what you'll find is usually the hype is greatest buying into resistance, which is just kind of the weird nature of how human psychology works versus how reality is when it comes to the charts. And I would say that's what I'm most concerned about. We've seen such an amazing rally in the NASDAQ. The NASDAQ 100, I think, is in the last 2+ weeks from this low is up about 15% from low to high. Now we're having a little bit of a pullback today, but for the most part, you have to be very skeptical. Number one, we also just went right into the 200. Now, by the way, look over here how they closed us above the 200 one time, and over here, same thing, right? And then look at what the market did. Now, it's not guaranteeing that's what the market's going to do here, but just like you were saying before, and I was saying, is that don't trust just one close above. It could be a fake out, and I would guarantee some people got faked out and went long right here before they got flushed out on the way down. That is basically giving you their playbook. They're saying that, listen, right now, inflation is our worst enemy. We are going to raise. They're even talking about 50 basis point raises multiple times this year. And if lowering interest rates and printing money caused us to rally so hugely during kind of the COVID period, which we had an amazing rally during, then it only makes sense that the opposite would happen if they're tightening. So yes, it's a great rally here, but again, I'd be very, very cautious. I mean, the Fed is basically giving you their playbook. Everyone used to say, don't fight the Fed. Now no one's saying it, right? Because it's the opposite. And I always find that fascinating how really, if you don't fight the Fed that way, well, you shouldn't be fighting the Fed the other way too on the downside. But now no one wants to say that. And I think it's something that investors need to hear because it makes sense. They're sucking out liquidity from the market. Arguably, the crypto bubble, which I call it a bubble back in 2021, was partially caused by that, by excess money in the system. Same thing with stocks. If they're pulling it back, you likely will see more downside, especially in stocks here. I think it affects them by the idea that you now have a relation, and you've always had this relationship where as interest rates go up, there's always a certain amount of money that's in the market that will rethink being in the market versus being in the bond market. So, if I were to say to you, well, right now you can get 2% in bonds or 1% in bonds, or you could be in the stock market and maybe make 15% for the year, but you're taking some risk. Obviously, being in the stock market, stocks can crash, they can have bad earnings. At those interest rates, you probably would say, well, I'll give it a shot in the stock market. But as interest rates go up, what if all of a sudden we had 20% interest rates? Now, I'm using a hypothetical that won't happen. But the idea is at a certain point, there's always investors that say, you know what, risk-free 5%. I don't trust the stock market. I don't trust that we're going to stay out of recession. I'm going to move my money to the safe haven of the bond market and get that return and take away that risk. And when you see that money coming out of the market, that's what then creates the downward pressure. So by the Fed raising rates, that's exactly what they're trying to trigger. They're trying to trigger a sucking up of liquidity that takes it out of the stock market, that takes it out of the consumer pocket and puts it into kind of a holding zone where people won't touch it. If we include the 50 basis points as what a one rate hike, then I would say likely just 2 to 3 more. All right. I don't think they're going to do 7 or 8 like now they're talking about. And the main reason I don't think it is because you are already seeing the economy starting to stutter a little bit. And again, people aren't really talking about this, but the housing market is already slowing down. We've seen new home sales start to crater because, not only are home sales at all-time highs, or I should say home prices at all-time highs, but now with the 10-year yield where it is and the 30-year, paying interest on a mortgage is becoming very, very expensive. So it's really increasing the amount of money to buy a house that it takes, and that's putting it out of reach for a lot of people. Then you add in inflation and what it's doing. When you have to fill up your gas tank and it costs you $100, $120, $140, that's hurts people. There's no doubt about it. So you're going to see that the Fed rate hikes slow the economy. Historically, that's been proven that it does that. And then you add in inflation, which is another tax on consumers, and now you're slowing it even more. So my guess is they'll get a few rate hikes in before they have to stop, but you will at some point see a recession, or at least close to a recession, by late 2022, and then probably a recession in 2023.